Private equity is one of the most powerful forces in modern business, but most explanations of it are either too technical or too dramatic. Here is the cleaner version. Private equity is not just money buying companies. It is a system of ownership. Investors raise capital from institutions, buy or finance private companies, influence how those companies are run, and try to create value before exiting years later. That sounds simple. It is not. Because once ownership changes, everything else begins to move: governance, incentives, debt, strategy, reporting, hiring, pricing, expansion, risk appetite, and the clock ticking toward an exit. This is why private equity can be constructive. A good owner can bring patient capital, sharper accountability, stronger management, better systems, and a clearer operating plan. Family businesses can professionalize. Growth companies can scale. Underperforming divisions can find focus. But the same model can also fail badly. If the debt is too high, if the assumptions are too optimistic, if cost-cutting replaces real improvement, or if the fund's incentives overpower the company's long-term needs, private equity can damage the business it set out to improve. So the real question is not whether private equity is good or bad. The real question is what kind of ownership is being practiced. Look at the system behind a deal. Limited partners provide the capital. General partners manage the fund. Management teams run the company. Lenders provide debt. Boards set direction. Employees, customers, suppliers, and regulators all shape the outcome. When those incentives are aligned, private equity can become a disciplined engine for building better companies. When they are misaligned, the same machinery can become fragile. India makes this especially interesting. India has fast growth, founder-led businesses, family ownership, rising digital infrastructure, global investor interest, and governance standards that are still maturing. That combination creates opportunity, but it also demands humility. In India, a spreadsheet is never enough. Investors need to understand promoters, culture, trust, regulation, succession, execution quality, and exit routes. The numbers matter, but context decides whether the numbers are believable. This is the lens of capital in the shadows. We will study private equity as a living system: history, valuation, fund structures, sourcing, diligence, portfolio management, exits, ESG, cross-border investing, limited partners, careers, and the psychology of judgment. The goal is not to make private equity look heroic. The goal is to make it legible. Because once the system becomes legible, founders can negotiate better. Students can learn faster. Investors can ask sharper questions. Policymakers can see the trade-offs more clearly. And everyone can better understand how modern ownership actually works. Private equity is not just about buying and selling companies. At its best, it is about taking responsibility for them.